Thank you, Rachel. Good morning, everybody here in the room, and good morning to everybody out there in the world. I see we already have a few people from around the world, which is pretty exciting. So welcome. My name is Ben Hron. I am a partner in the law firm of Brown Rudnick here in Boston, and I'm here to talk to you today a little bit about raising your first round of capital. Whoops, my notes are in the wrong order. That's not helpful. So every business needs to raise capital, or needs to have capital, I should say. And for most companies, the initial capital the company uses comes from the founders. Usually they'll put in some money when the company gets going. And for a lot of companies, they don't need to raise additional capital. They can just run from operations, use the capital from operations. But if you are in a high growth, highly competitive industry, like say high-tech startups, it is pretty likely that you're going to need to raise some capital from outside investors at some point in order to keep up with the competition. The purpose of this presentation is to sort of talk to you a little bit about the process for raising that capital and some of the steps you'll need to take to get there. So I've been working with startups my entire career, which now spans 19 plus years. And during that time, I've advised thousands of entrepreneurs on basically the process of launching and growing a business from inception to exit. In this case, my goal is to help to sort of use some of my experience to help you better understand the fundraising process and some of the key legal and business issues that that are part of that, so you're well prepared when you go out to raise that initial round of capital. I'm going to focus on raising capital from institutional investors and specifically from venture capitalists, but a lot of the stuff we're going to talk about would be applicable if you were raising capital from angel investors, angel groups, or even other sources like the crowd. Okay, and I'm happy to discuss some of those differences when we get to the end of the presentation if you have questions. By the way, can we turn the volume down just a touch on this? Or do I just, yeah, thank you. I'm getting an echo. Thank you. So I want to be clear at the outset that I am a lawyer. I'm not a venture capitalist. I'm not an entrepreneur. So this presentation is necessarily going to focus on the raising capital aspects sort of from my experience and my perspective, and it's going to exclude some things that I'm just not an expert in, like the finer points of financial modeling, for example. Just in case anybody wasn't clear that I'm a lawyer, I've included this handy dandy disclaimer to tell you that I am in fact a lawyer, but that none of this is formal legal advice. In a nutshell, the disclaimer says just simply that, look, there are a lot of different situations out there. What I'm going to talk about is not necessarily applicable to your situation. So you should go out and seek your own counsel or me at the time you're going out and to raise capital. Okay. So I'm going to break down the fundraising process into 3 big steps and a handful of smaller steps. I'll start by talking about some actions that you should take before you actually go out and start pitching investors. Then I'm going to talk about how to go about identifying investors and meeting them. And then finally, I'll talk about the process of papering the deal from the time you get a term sheet to the time you actually get the money. And at the end, I'm going to discuss a handful of ways in which you might be able to help control the costs of raising capital, which can really make a difference, especially when you're raising a smaller amount of money, which is oftentimes what happens in your first institutional round. So before you actually start to approach investors, there are 3 things that I think you should do, I recommend you do, to sort of help you set you on the right path so that hopefully you won't end up with more problems later. First, you have to figure out how much you want to raise. And note that this isn't necessarily the amount you will actually ask people for, and it's not the amount you will necessarily raise, but you have to have some concept of what you think you need, right? So the general rule of thumb is that you need to raise enough money to get to the next fundable event. So if you were trying to go from sort of proof of concept to product market fit, you have to understand what that timeline is going to look like. And you need to use do some Excel spreadsheets, some modeling in order to figure out what your expenses are going to be and what you expect your revenue to be over the course of that period of time. And then you need to build in a buffer because inevitably things cost more. Inevitably revenue isn't quite what you hoped. Inevitably things take longer than what you'd expect. So it's a good idea to basically model this stuff out in different scenarios and come to some number that you think you're comfortable with will be sufficient to get you to that next milestone, even with that buffer. Second, you need to hone your pitch. There are legions of blog posts and YouTube videos and all sorts of things out there that you can find to help you go through the finer points of actually making a pitch. But I'll just mention a few things. It's important to know your audience and tailor the pitch to your audience. Understand who you're talking to, what their background is, what their area of expertise are. It's important to be able to speak confidently about your market and your competition. You shouldn't be in a situation where somebody else who you're talking to knows more about your competition than you do. And you need to try to anticipate and preemptively answer the questions that you think you're going to get from whoever you're pitching to. Okay? You won't be able to answer all the questions, but it is helpful to make clear that you've thought through those questions before you walk into the room and help to try to answer them. Remember that the pitch is not something that has to be static. It's not something that you have a pitch and you use the same thing over and over again. As you go through it, as you practice it, and then as you start to present it to investors, you will get feedback and you can use that to continue to refine the pitch. And you should, because it'll help improve the pitch as you move forward. Finally, it's a good idea to make sure that there are no legal issues that are going to be red flags when you get to the point of actually pitching an investor. If you don't have a lawyer at this stage, it's a good time to get one, because what the lawyer can do is help you. It can go back through the paperwork for your company up to that point and help you understand and help basically identify places where there's going to be problems and help you fix them in advance. In any fundraising environment, but particularly one where it's more competitive, investors are almost looking for ways to eliminate companies, right? They get way more opportunities to invest than they can possibly handle. So just like a college admissions process, you're going through it and you're trying to figure out what eliminates people on the first go before you get to the point of saying, okay, these are the people we want to hear from, right? So eliminating those little red flags can help grease the skids and make things a little easier as you move forward. Once you're ready to approach investors, the real work begins. So even in a difficult fundraising environment, there are hundreds of billions of dollars being invested by thousands of investors, venture capitalists, angel investors, etc. So one of the first problems you have is actually finding an investor that's a good fit for you. If you're located in a major startup hub, Silicon Valley, New York, Boston, London, Hong Kong, Beijing. If you're fortunate enough to be in one of those geographic areas, the best bet is probably to start closer to home and look at the investors in your greater area for two reasons. One, investors do have a bias towards investing in companies that they can meet in person and they can keep close tabs on in person, even in this virtual world we're now in. Two, it will simply be easier for you to find a common connection, either meet them directly or find a common connection, so you can get the warm introduction that you want in order to start off a relationship. Beyond geography, you want to screen for investors that are investing in companies in the same industry and the same stage of development. If you are a consumer-facing company, then an enterprise software, a venture capital firm focusing on enterprise software isn't where you want to be, right? If you're looking for seed capital, there's no point in approaching a growth stage capital fund, right? You want to screen it down to try to get a narrower list of investors that you actually want to approach. There's plenty of information freely available on the internet, but before you go spending hours and hours pouring through the websites of hundreds of venture capital firms, ask your lawyer and ask your other advisors if they have access to one of the data aggregator sites out there like PitchBook, which will allow you to screen companies much, much faster, because they'll let you filter by geographic region, by stage, by industry investment, down to the investor, the individual VC level. So if you have that access, it can greatly accelerate the process of screening, of finding investors. Once you've narrowed the list down to 20 to 50 potential investors, you should go through and review the bios of the individual investment partners on the website, or investment professionals on the website, to figure out who your internal champion would be. Who's the person who actually is investing in your space? Even within a fund, there's going to be some investors focused on one area and some investors focused on another. Find the one or two or three people in there that you really want to make contact with, that you think would be able to help move you through the fund's investment process. You also need to identify anybody in your network that can provide a warm introduction to that fund, and better yet, one of those individuals. Work your network. LinkedIn can be a great source of this, a great source for figuring out who might have common connections. But don't be afraid to simply reach out to people and say, hey, do you know somebody at X? I'm trying to get an introduction. If you're in the same geographic, if you can't find somebody who actually is in your network, try to find other ways of making a connection. If you're in the same geographic area, networking events can be really helpful. If not, then, or even if you are, industry events are another good way. If you're in an industry where there are events where everybody shows up, not a bad place to try and meet other people who either might be a potential investor or might at least have those contacts to potential investors. Keep in mind that the goal is to develop a long-term relationship. So don't move too fast and try not to come off as desperate. This sounds a little like dating, kind of is. Most of the companies that raise capital from VCs or other institutional investors do so by selling those investors some form of security. And there are really three principal types of securities that get used in seed stage financings. Something called a SAFE, which stands for Simple Agreement for Equity. A convertible debt, which is debt that converts into equity or is supposed to convert into equity, and preferred stock. Now, convertible debt and safes are very similar. Convertible debts have been around for a very long period of time. They basically came up as a way to avoid having to establish a valuation on a company, which is an important thing at the earliest stages, because it is hard to pin a valuation on a company that might not have any revenue, much less profits. And the way it works is essentially that somebody loans you the money, and when you go out and raise your next round of capital, that debt converts into equity in the next round at a discount on that price to compensate them for the fact that they came in early. Safes, which are a more recent creation, are basically the same thing, except it's not a loan. It's more like a prepayment. You give me the money now, I'll promise to give you equity later at a discount on the future price. Safes have become, in the last few years, sort of I would say, the primary instrument that we see companies use to raise early stage seed capital. And that usually means the round is certainly below $1 million, and even up to 2 sometimes, depending on the company and the investors. Preferred stock is stock in a company that has certain rights and preferences above and beyond your typical common stock investor. So common stock is what most of the stockholders would have, certainly the founders would have, employees would have if they get equity. Preferred stock means that you will have certain preferences on an exit. You'll have certain special voting rights and other rights that are beyond the scope of this presentation, but that I'm happy to talk about offline. The type of financing you do, safe, convertible note, or a preferred stock, will largely be driven by the amount you're raising and who you're raising it from. If you're down below $1 million, preferred stock typically isn't the most effective way of raising capital because there's too many variables, and I'll talk a little bit more about the cost of capital in a second. But once you get up above $1 million, and certainly at 2, you can raise a pretty cost-effective preferred stock round. There are some investors out there that simply won't invest in anything but stock. Angel groups and VCs that don't want to deal with safes and convertible notes. In that case, you're going to end up, if that's your investor, you're going to end up in a preferred stock round. There is no right answer to how much to raise which form to use for raising capital. The biggest issue really with using preferred stock is establishing a valuation. If you can come to an agreement on a valuation, a preferred stock round is not a tremendous problem, other than the additional cost. Regardless of the type of financing, it's a good idea to start with a term sheet. The term sheet summarizes the key terms of the deal. And the real advantage to this is basically that you get out of the way any disputes up front before you're too far down the line, you've spent too much money on legal fees. You don't want to be near the finish line when you discover that there's some intractable dispute that kills the deal. So flesh out the terms ahead of time. The good news is, for safes and convertible notes, there aren't that many terms to negotiate. So term sheets are pretty short and negotiations are pretty easy. For preferred stock, there is a lot more to negotiate, but the terms are relatively standardized. The National Venture Capital Association has a phenomenal set of model documents that is used as the basis for most of the early stage financings in the United States. Now, different firms, different funds will have variations on those NVCA documents, but the fundamental terms of the stock are typically the same. So you're negotiating, even though you're negotiating over more terms, you're negotiating usually within a fairly narrow range, which helps make the negotiations a little bit easier. If you want to, you can go on to the NVCA's website. I think it's nvca.org. The model documents are there, including a model term sheet, which has annotations in it that will help you understand the terms. You can also go to my LinkedIn page, where you'll find a presentation that I gave about 2 years ago. Actually, you'll find the handout from it called Anatomy of a Term Sheet. And it goes through literally line item by line item in the NVCA standard term sheet and talks about the terms, talks about what you should care about, talks about what you should not care about, talks about basically the negotiations that go on, and helps to educate you on those terms so you're prepared once you get to talk to an investor. With that said, I'd be remiss if I didn't mention that this is a point where you do want to include your lawyer. You are going to be in a situation where you're negotiating against somebody who has done probably hundreds of these term sheets before. They know the ins and outs. They know the trade-offs. Most of you would probably be in the situation of negotiating one of these term sheets for the first time. It is helpful to have an attorney who has been through it before, who can not just help you understand the terms, but also help you understand the trade-offs. Particularly in a preferred stock financing, where there are a lot of terms, it's important to understand how they interact. Generally speaking, the preferred stock terms can be divided into economic terms and control terms. Economic terms are ones that impact how much money when the company is sold is everybody going to get. Control terms affect who gets to make the decisions while we're running the company. And there are generally trade-offs for both you and for the investors. And understanding those trade-offs will help you make an informed decision based on your risk profile. You may really be concerned about losing control of your company. So you may be more interested in making sure that the financing includes terms that allow you to maintain that control. On the other hand, you may say, I don't care if the company gets taken over, but I want to make sure that if the company gets sold, having basically come up with this idea and started it on my own, I want to make sure I'm getting paid for it. Right? It's important for you to understand and recognize what your concerns are so that you can make the right decisions about the terms that you want to invest on. So once the term sheet is signed, your lawyer and the lawyers for the investors will start documenting the deal. For a preferred stock, for a safe financing or a convertible note financing, this is pretty straightforward. Again, relatively short documents, relatively easy deals, not a lot of terms to negotiate. Still more paperwork than you'd probably expect, but not a long process. The hard part with convertible note and safe deals is typically more that you're raising money from a syndicate that could oftentimes be 10, 20 or more investors. And so you're herding cats, right? You have to share the terms with everybody. You've got to get feedback from everybody. You've got to get everybody to sign the documents once you've finalized them. You got to collect the money. It takes time. And that's really where a lot of the extended time and money comes in, cost comes in for a safe or a convertible note financing. For preferred stock financing, you are more likely to be dealing with one lead investor who's taking most of the round, or maybe two. So the negotiations are more one-on-one. There's fewer people that you have to wrangle in order to get the deal closed. But there's more terms to negotiate. And so that back and forth will still take time. You could close a safe or a convertible note financing in a matter of weeks. Preferred stock financings typically are more like 45 to 90 days. Right? The other aspect that will be going on in parallel with this document, with the documenting the deal, is the due diligence. And the due diligence will actually start as soon as you start talking to the investor. But once you get into the deal, once you've got the term sheet ready, then you're going to start dealing with sort of the major legal due diligence and some of the more in-depth business due diligence. You'll get a diligence request list from the lawyer from the other side that will ask you to provide a whole bunch of information that hopefully, based on what we talked about earlier, you will have already prepared and be ready to send to them, right? The due diligence process is a way for the investors to get to know you, and what's disclosed in due diligence will become part of the documents in certain ways, because one of the things that documents do is help to allocate the risk between the entrepreneurs, the companies, and the investors. And so things that crop up in due diligence end up being dealt with in some way in the deal documents, because the investors are trying to make sure that they're not taking more risk than they intend to. Right? Once you've actually finalized the documents, you've got your investors ready to go, then you have to go through the closing process. As I said a moment ago, that's much easier when you're only dealing with one or two investors, much harder when you're dealing with a lot of investors. It will usually involve a fair amount of back and forth, both on your part, talking to the investors, and on your lawyer's part, talking to the other lawyers. And then you get the money, and you're good, right? So this is a rough estimate, very rough, of cost ranges for different types of financings. Safes and convertible notes, usually 7,500, maybe to 10 grand. Can get up to 20. I don't generally see them going above 20, but on the company side, investor counsel is usually less because there's just less to review. And typically in a safer convertible note financing, your lawyer is going to draft the documents. In a seed, pre-seed, or Series A preferred stock financing, costs are much higher, deals much more complicated, and at the pre-seed or seed stage, sometimes the investors counsel drafts, sometimes the company counsel drafts. And who drafts will sort of will determine in part basically which expenses are higher. At the Series A stage, typically, particularly if you've got a VC involved, their lawyers are going to draft the first set of documents, and you're going to be reacting. To some degree, the cost on either side doesn't matter, because certainly when you get to the preferred stock stage, the investors usually require that you pay their legal fees, at least up to some cap, out of the proceeds of the transaction. Okay. So in order to control costs, it's helpful to understand how to think about it. And there's really two ways of thinking about costs for financing: absolute costs versus the sort of cost to capital ratio or capital efficiency, and then explicit versus hidden costs. So absolute cost is simply the cost of the transaction was $25,000, right? Now, $25,000 is more than $10,000. But if you pay $10,000 to raise $50,000, that's a lot less capital efficient than if you pay $25,000 to raise $1 million, right? So to some degree, what you have to think through is, if I'm going out and raising capital, am I raising enough to make it capital efficient, right? And you do need to keep in mind that these fees are going to come on the back end when you're figuring out how much you're going to raise. I have companies or entrepreneurs companies sometimes that say they just want to raise $100,000, which is great if somebody's simply willing to strike a $100,000 check, but not so great if we've got to negotiate terms and and basically go through a whole deal process, right? Or you want to do it in $5,000 checks from 20 people, right? So think about that when you are planning a raise. Explicit cost versus hidden costs is really, the explicit cost is the dollars you have to pay. The hidden costs are down the line. What are the things that will cost you money if you didn't do it right the first time, right? So if the terms of the deal end up being disadvantageous to you, will you end up spending a lot more money in the future? For example, if you negotiate a term sheet without the benefit of counsel, and then you have a lawyer help you through the transaction, and they look at the term sheet and they say, look, have you thought about this, this, and this? And they raise issues that are actually of a major concern to you. Now you have to go back and try to negotiate those issues after the term sheet has been signed, which is much more problematic because the investors, not surprisingly, feel like they're being retraded and oftentimes want some sort of consideration for those concessions. That is oftentimes a much more fraught negotiation than it would be had you simply raised those issues at the term sheet stage. Same thing happens if you end up with terms in the eventual deal documents that are problematic to you in the future. Okay? So with that in mind, it's helpful to think about what are the variables that basically impact cost. The complexity of terms and deviation from the norms. So I've talked about complexity in preferred versus safes and convertible note financings. Deviation from the norms is simply there are industry norms in this space, which is great because there didn't used to be, and financings, even Series A financings, used to cost $150,000, right? Now we have sort of a set of standard norms, which makes things a lot more cost effective, unless you decide that you want something out in left field. So take the advice of your lawyer and your advisors on basically how to make sure that you're not too far off the beaten path. Okay. If you have other concerns, there can oftentimes be other ways of addressing them, but try not to do anything too unusual. The sophistication of the investors can have a big impact on the financing. And this is sort of related to point one in reverse. If you are raising money from investors in this space, they will know what the standard terms are, and they will understand that the goal is to spend as little money on legal fees as possible so that as much of their money that's going to your company can be put to use to build your business. So that will help make the negotiations a lot simpler. If you raise money from somebody who is not normally investing in startup companies, think guys in finance in New York who are usually dealing with large companies, bankers. They will oftentimes ask for terms that are much more protective of them than standard VC investors. And the consequence of that is the deals get a lot more complicated. The negotiations become a lot more fraught, and the terms can sometimes be a lot less advantageous to you. Now, if that's your best option for financing, then you work through that. But understand, particularly at the early stages when you are screening investors, that is potentially a hidden cost that you will encounter going down the road. Same thing is true of investors that are unsophisticated in the other direction and don't understand the first thing about investing in startups or financings in general. In that case, you can end up spending a lot of time explaining to them why you're not giving them a mortgage on your house to protect them against the financing, or explaining to them why they won't actually be repaid if the company fails. Right? So making sure you have investors that are sophisticated can considerably help and smooth the way in the financing process. Having a lead investor particularly if you are dealing with a syndicate of investors, can be tremendously helpful. You want somebody who can bring other people along, who has the gravitas to simply say, these are the terms I've agreed to, and therefore they're okay for you. Not everybody can do that. It is usually the person who's writing the largest check. It is not necessarily the person who is writing the largest check. But having a lead investor rather that you can negotiate with directly and can help you then bring along everybody else will save you a tremendous amount of time and money, especially when you're investing with or you're raising money from a syndicate. And then, of course, lawyers. Quick question: what's the biggest cost in raising capital? Legal fees, right? It's just true. That is going to be your single largest out-of-pocket expenditure when you're raising capital. Having an attorney who understands the process and can help you move through it efficiently will save you money. Now, the irony of it, or the trade-off, is those people oftentimes have higher rates. So it is something you have to sort of reconcile. In the long run, you will be better off with an attorney who knows what they're doing, even if you pay a little more money in this particular transaction. So my recommendation to you is build a little more buffer into the amount of money you're raising. Work with your lawyer to try to get to make the terms more favorable to you. Work with your lawyer to try to make the deal more efficient. And then don't worry about the final bill. I don't want to say that. That's not fair. But recognize that it's an investment that you're making in the future, and that the money's coming out of the investor's pocket as well as yours. So a few tips for controlling capital. I've sort of gone through these already, some of these, but choose an appropriate financing structure. If you're raising under $1 million, bad idea generally to raise preferred stock financing unless you really are dealing with one party. Stick close to standard terms. Start with a detailed term sheet. As I talked about, that will help make the rest of the deal go more smoothly. Select your investors carefully, find a strong lead, and hire a good attorney. And that is what I have. So I wanted to give everybody ample time to ask some questions about whatever they want. And I don't know if we learn how do we do this. Audience first, web first.
Yeah, so it looks like we actually have 2 right now in the Q&A tab. So if we want, we can toggle between virtual and in person.
That's fine with me. How are you going to do it?
Perfect. So one of the questions that we have here in the chat says, in your experience, have you seen VCs consider startups with one co-founder more risky as an investment, or are those VCs that prefer single co-founder companies?
I think from the investors, first of all, at the earliest stages, I think there's recognition that sometimes you just don't have the team together, right? But you've probably all heard that investors invest in people, not in ideas, not in technology. It's the people that are running that basically make the difference. So it is a plus if you already have part of that team together, right? Because if you don't, you're going to have to go out and find those people. Now, it's not a disqualifying characteristic, but it will help to have your team more put together at that point in time.
Do we have anyone in person that has a question?
Go this way.
All right, I will walk the mic over to you.
Hey, thank you for doing this. This was really helpful. I was wondering if you had advice in particular for first-time technical founders who have, extensive career experience in a subject domain, but are really new to the startup world and particularly to fundraising.
That's a broad question. Advice in what respect?
I think the first part is I think there's a lot of imposter syndrome among people who are doing this for the first time, and from somebody who's seen this before, I guess what are the things that increase the odds of success for founders like that you've seen?
Well, since you mentioned it, one of the things I'd say is you're in good company. Having worked with a lot of entrepreneurs, that feeling of imposter syndrome, as you described it, is hardly unique, right? So and it's not necessarily talked about, but being a first-time entrepreneur is hard, right? One of the things I like saying to entrepreneurs is I'm not here to tell you what risks you can and can't take most of the time. What you are doing is inherently extremely risky. Everybody here could make a lot more money with a lot less risk doing something else, like, for example, being a lawyer. So it is a risky thing to do, and I think you sort of embrace that risk. And beyond that, my advice would be to try to seek out advisors and, frankly, fellow entrepreneurs who can be a support network for you. There are a lot of technical solo founders, right? There are a lot of non-technical founders out there. Nobody has all the characteristics, or very few people have all the characteristics that you need to really build a business on your own. So network, go to events like this. I think the pandemic has been hard for that. And I think that's one of the things that we've lost, and being back in person is really valuable. I mean, back earlier in my career, when I could do this a little more easily, I was at events 4 or 5 nights a week, basically living off pizza and beer with other people. And it was just a great community environment. And a lot of the people that I met in that environment have turned into successful entrepreneurs. And so I think, and they didn't start that way, right? And so my advice is create a community around yourself. You're definitely not alone.
Thank you.
Yeah.
We have another virtual question that came in. It says, one of our co-founders is a lawyer. How will that impact our cost? And is it advisable to get additional counsel?
Okay. So, I mean, I think I would say it sort of depends on the type of lawyer, right? And the type of business. If your lawyer happens to have expertise in the area in which you are working, that could be tremendously valuable. If they went to law school and that's sort of the end of their legal career, then my guess is they can be helpful to you around the margins, in understanding things, in maybe doing some of the baseline, some of the basic legal work that will help to reduce the costs, but it's going to be less. It's not going to be a tremendous cost savings. In either case, you will need an outside counsel, because no matter what the expertise is of your founder, you're going to run into legal issues that are going to be beyond the scope of what they know. If you're just talking about the specifics of raising capital, I would suggest, and I really think it's probably pretty imperative, that you have an outside law firm that can help you through the process. Even if your co-founder is a lawyer, they likely haven't gone through a number of financings. They're not likely to be as well versed in the terms. They're also not likely to have the bandwidth, since they're also doing whatever else they need to do. They're not likely to have the bandwidth to turn documents at 2 o'clock in the morning so that you can get the financing done more efficiently.
All right. And then I think we had a couple more in person.
Thank you. In this scenario that co-founders invest capital along with friends and family or angel investors, is there any process that's typical for co-founders to paper in their equity, or is it normally just part of the founding shares?
So let me just clarify something.
Yeah.
When you say they're investing along with others, so
Yeah.
there's sort of 2 things that can mean. One is, at the very beginning when the company is formed, you're going to get equity. And everybody, the founders get equity, typically just in exchange for what we use is a document that assigns any intellectual property rights, any knowledge that that founder might have to the company. It's sort of ephemeral, right? Sometimes you have something tangible, but most of the time it's the idea. And you're assigning that in exchange for stock. That's different from putting actual cold hard cash in. Are you talking about actual money?
Cold hard cash with angel investors.
Okay. So if you're doing it at the same time as the investors, there's no reason you shouldn't get the same terms, right? If you're putting in money at the earliest stages when you're simply getting the company off the ground, if you're running up some money on a credit card or something like that, or putting in actual cash, that typically will either be repaid at the time of a financing, or more likely you can negotiate to roll it into the round, right? If you're putting in money at the time of the round, there's no reason you shouldn't be able to say, look, I'm putting in $50,000 of my own money. I'm going to get the same terms.
But it is typical as well if you're running up cash beforehand to get repaid over time.
So it is, first of all, it's generally a discussion, right? So if it's a little bit of money and you really want it paid back, oftentimes that's possible. If it's a larger amount of money, most likely your investors are not going to want to take the money they just put in to pay you back, right? If there is a reason for it, for example, you've run up a lot of credit card debt, it's high interest debt, you can oftentimes, get some sort of accommodation for that. But if you're putting in money, just, frankly, personal money that you have, a lot of times what they'll say is, just come along with us, basically.
Yeah.
We're not going to pay you back on that, but we'll let you take the same terms that we're going to get.
Makes sense. Thank you.
Yep.
Awesome. We have some more questions streaming in. So the latest one says, what is the best way to protect ownership or control in the company when deciding how much to raise versus equity and valuation?
Say it one more time.
What is
on the board?
Yep.
Oh, okay. So, and actually, before I do this, I'm just one quick note to the people in the room. I will stick around afterwards to answer more questions. So I know we're running low on time, so just don't worry, I will be available. At the stage of or if you're doing a safe financing or a convertible note financing, there typically isn't that much control that you're going to give up at that stage. The investors may want the right to appoint an observer to your board. They may want some information, regular information from the company. In some cases, they may even want a board seat, but you're not likely to lose much control at that stage. When you get to a preferred stock financing, things are different. The investors are putting in more money and they want to be able to look after it. You should expect to give up some amount of control over the company at that stage. But usually what you're giving up or what you try to limit it to is effectively negative control rather than positive control. In other words, it's typical to give the investors a veto right, a block over certain things. It is less typical and more problematic to give them the ability to force something down basically on you. A simple example is a sale of the company. You don't want to be in a situation, if you can at all avoid it, where the investors have the ability to force a sale of the company on you. But allowing them to block a sale of the company is fairly standard. You maintain the control, frankly, by raising money at a higher valuation, if you can, to reduce the investor's stake, negotiating favorable terms on board rights, on vetoes on stockholder votes, to make sure that you aren't going to be pulled or forced into anything. And it's a little beyond the scope of this conversation, but it is something I talk about in the Anatomy of a Term Sheet pamphlet that you can get on my website, on my LinkedIn page. basically that there are certain levers that get pulled to, or I don't know, levers is the wrong word. There's certain terms that will impact the control going one way or the other. And so it's helpful to understand those up front. And if you have a concern about them, make sure it is in the term sheet. Make sure that the board composition is one that you still have some control over, that it's not a board that basically investors will end up controlling. It's that the protective provision, that the investor's ability to veto terms or veto actions aren't too broad, and that their ability to force things on you isn't preferably non-existent.
Awesome. I think we'll do one more in person, and then we'll do one virtually, and then those in person, Ben will be available afterwards.
Hi, Denise Valenti. I'm the sole owner of IMAD, Impairment Measurement, Marijuana and Driving. When we first formed our company in 2016, because we were a unique space, when we approached investors, they were always interested in talking to us because they're curious and we had a substantial background. But up front, no, we can't even spend money on you because of sin clauses. Now that the political landscape is changing, what we actually did is we went for federal grants, which was successful. We're back in looking at investors. We're struggling to identify those, because we know they're there, that have an interest so that we're efficiently using our time. Those resources like PitchBook and that, is that a way to understand how they stretch the sin clauses?
Not necessarily specifically, although you can certainly find it would certainly help you find investors that are investing in the cannabis space generally. I'm going to answer your question by telling you that I have a former colleague who does a lot of work in this space that you might be a good connection for you.
You're good. All right. And then we have another question that is coming through. So it says, you mentioned earlier the controlled term versus the economic terms. If a founder is more focused on controlled terms, then what are an example of some controlled terms that are favorable to the founder?
Okay, this is pretty similar to the last question. So I'll try to answer it quickly and then maybe we can get one more. Control terms are things like board composition, effectively, how many directors are there and who appoints those directors. What's called protective provisions, which are the portions, basically the rights of the investors to veto certain actions of the company. So you want to keep those as narrow as possible. Things like, lost my train of thought. Redemption rights, the ability of the company to force, the ability of the investors to force you to repurchase their stock under certain circumstances. Drag along provisions, the ability to force you to sell the company under certain circumstances. So that's a handful of them.
Awesome. Do we have any more in-person questions?
Great stuff, Ben. So for founders that are the accelerators, there's a trend going on where accelerators are offering founders money to join their accelerator, and those where are more selective. For founders looking to find their lead investors, would you recommend they look into these accelerators or join these accelerators? And does it matter what state they're in from your experience?
Okay, interesting. An accelerator with a good reputation is worth whatever you can do to get into it. Something like a Techstars or a Y Combinator are just they're gold, right? There are a lot of accelerators out there that it's not really entirely clear what they're offering to you beyond a little bit of money sometimes, and ostensibly some advice. I would diligence those pretty carefully. It's not to say there aren't a lot out there that are worth doing, but frankly, there's just too many of them at this point to keep track of. I don't think geography should be an impediment. A lot of them now will permit a fair bit of virtual participation. Now, I do think the in-person participation is really valuable because the connections you're making with your fellow entrepreneurs can be, frankly, some of the more valuable connections. So, look, I would definitely not say don't do it, but do your homework. Talk to the people that have been in the programs. Push them a little bit on exactly what kind of additional value they're adding. Think about what it's going to do to your business, to what the trade-offs are between spending that time in the accelerator, maybe in a different state, versus basically growing the business without it. So, yeah.
Awesome. And then we have one more that came through. What is the best corporate structure to start with? LLC versus S Corp versus C Corp?
Okay, so this is an entirely different presentation, but the short answer is for high growth, like high tech startups. 99% of the time, a Delaware C corporation is where you want to be. There are tax reasons for it. There are legal reasons for it. There are practical reasons for it. But that's the short answer. There are circumstances in which an LLC or an S Corp can be an appropriate entity, but it's more, it typically is better for companies that are not very capital intensive. It's better for companies that are slow growth, throwing off revenue that you're going to distribute out every year. So it's the short answer.
Sure. And then just to wrap up, what is the best way for people to contact you?
Oh yeah, I probably should have put that up earlier. Well, first of all, you can find me on LinkedIn. It's Benjamin Hron, Hron. There are not a lot of Benjamin Hrones on the internet. You can find me on Brown Rudnick's website, and you could reach out to me afterwards here. I'm happy to be a resource.
Awesome.